We recently worked with a couple really nice people and helped them avoid financial catastrophe and wanted to just share a little detail with you. Hi, I'm Michael Shotnik, the reverse mortgage man with Sierra Pacific Mortgage, here to help with anything retirement and or reverse mortgage related. You can always reach me at the number below and or shoot me an email and would love to help. In our sit down with the couple, you could really sense the stress of the financial situation. They did share the fact that their 401k was fully exhausted and that they were going to start having to use credit cards for surprise expenses, and they were coming up short on a monthly basis, so they were going to have to start using credit cards more regularly. We all know that's a vicious cycle, and you could really sense that they understood that, and it really concerned them. They also shared that they had never paid credit card interest in their life. They'd used credit cards, but always had the ability to pay them off. But with the 401k being exhausted, they weren't able to do it, and they were really in a tough spot. This couple had a home value of roughly $583,000. They'd done a really good job of attacking the mortgage debt during their professional lives and had paid the balance off, so they didn't have a mortgage. So that allowed for a handful of options. One, they could take a lump sum that they'd never have a payment on. The downside there is they didn't need all that cash all at once. All they needed is when surprise expenses popped up and or they ran over their budget on a monthly basis, the ability to access some funds, but not a large amount. Secondly, they could have created a monthly income stream, but again, they didn't need income each and every month. They really just needed a bit more security. And that's why the line of credit seemed to make the most sense. Is the line of credit sits there idle and when they need to tap into it. So if they determine that they're going to come up short income versus payments on a monthly basis, they can take a draw from the line of credit. And at that point, that's when interest accrues. Again, they never have a payment on it, but interest accrues on the balance only when those funds are borrowed. In addition to that, and this wasn't really the point of the line of credit, but a nice feature is the unused portion will grow over time. So day one, they have a line of credit in total of $240,000. That number will continue to grow and maybe be better designed to keep up with their finances, but definitely more dynamic than the other options. On a needed basis, when they need access to those funds, they have options. They can request a disbursement online. They can submit the request by mail. They can fax in a request form, and they can also email in the request form. So there's many different ways that they could request the funds. At the end of the transaction, all involved felt really, really good about the service we had provided and the sustainable situation we'd helped them kind of navigate into. The line of credit offered them probably more access to cash than they would ever need, but that's okay. Again, they're only accruing interest on the funds they tap into, and it's there if they ever need it. Again, Michael Shotnik with Sierra Pacific Mortgage. If you need me, feel free to call me at this phone number and or send me a request by email, YouTube comment, whatever works for you, and I'd love to be of assistance.